Hello and welcome to this month's monthly Q&A. So the first question is, can you please refresh our memories on what's the ideal way to add stocks to our portfolio, especially for new clients or clients who started aligning portfolio with long-term picks? It's difficult to enter a stock that has moved upward significantly. The next question is, when you give an exit call, we may be at a loss due to the timing of entry in that stock. Yes. How to overcome the hesitancy to book a loss? And the last question is, how do you expect your ideal subscriber to behave with respect to the long-term portfolio when to buy, when to sell, when to add more? Okay. So first of all, there is no ideal way, right? There is no single way that you can build a portfolio. Uh, See, the broad contours that you need to remember is you need to replicate all the stocks in the portfolio, because when I am recommending a stock, even I do not know which stock is going to perform, how each recommendation is going to perform. When I am recommending or when I say I like a particular stock, or when I'm recommending a stock, usually, if not usually, I will always believe that it is going to do well, right? I mean, otherwise, why would I recommend? But the fact of the matter is that only 60-70% of the stock calls will go right, and others may lose money or may not do very well. So there is no way for me to predict which ones will do well and which ones will not do well. So to get an aggregate return of all the recommended stocks, basic idea is to sort of buy all the recommendations. The second point that I always want to highlight is that, uh, especially in a new recommendation, or more especially if you are a new joinee, you're building up your portfolio, it is always more prudent to space out your buying a little bit. So if you want to invest 100 rupees, do so. Maybe you decide that, okay, I will every week I will put in, say, 20 rupees, and you do it in a systematic way, right? You make an Excel sheet, just write down the allocations of the stocks, how many shares you will need to buy on, let's say, the first day, right? You make that Excel sheet once, and then there will be minor modifications going forward, because every time the price will change, but roughly you will get an idea as to how to execute it over the 4 5 number of days. So space it out, maybe do it once a week for 4 5 weeks. Somebody who's a little bit more uh, whose ability to take price risk is a little bit more, can actually do it in maybe 2 3 tranches or even one shot. There's nothing wrong even in doing one shot, but what I have personally found is that psychologically it is easier if you spread it out, especially when it is the first time that you are starting to build a portfolio. Similarly, when you are doing a monthly SIP, just keep adding every month. I mean, don't overcomplicate matters. Uh, the only complexity that arises is if your, say, monthly SIP is, let's say you want to do an SIP of 10,000 rupees, and 10,000 rupees will not cover, say, buying one share each of all the stocks that have been recommended. So what do you do? In that case, again, let's say there are 20 stocks in the portfolio. Say buy five in the first month, buy stocks number 6 to 10 in the next month, by 11 to 15 on the third month, and so on and so forth. So basically, just do a very simple, uh, uncomplicated way of doing it. The worst that will happen is that your returns will vary a little bit from the recommended portfolio returns, which is okay. I mean, you're not, and that variance will be, uh, it will not be very large. It might be a couple of percent here or there. And over a period of 3 to 5 years, that variance also will not be a significant amount, right? Because typically we buy a stock and hold on to it for some time. Okay. So that is the way I recommend people to buy into long-term stocks. When when you're unable to buy higher, average up higher, or whenever you feel that you are not able to sell a stock when an exit call is given, just ask yourself this question: then why is it that I am unable to sell or unable to buy? Right? Because what happens is you are basically getting anchored to price. There's a lot of mental biases are cropping in. One of them is price anchoring. Then you have something what is known as endowment bias. So which basically means that you fall in love with the stock that you own. Price anchoring. So you get anchored to a particular price, which could be your first buying price, or which could be when you are buying. A lot of people have difficulty buying higher than what they bought at, or in typical in my long term portfolio, if a stock is there for some time, typically what has happened is the stock price has gone up. So if I recommended a stock at 100, today it is at maybe 150 or 200. And a lot of people ask this question that should I buy, because you recommended it 100, today it is 200, should I buy? The point is that that is what it is expected, right? Why will you hold on to a stock uh, for 5 years, 10 years, 20 years if the price does not go up? It doesn't make sense, right? So the natural expectation is with time the price is supposed to go up. And that is the nature of all compounding kind of businesses, which is what we try to focus on in the long term portfolio. So it is the initial recommendation price, or the price that you have bought at initially, is completely irrelevant to what you need to do today. Right? Similarly, when you are selling, the price that you have bought a stock at is completely again an irrelevant data point. The stock, if you bought a stock at 100 and today it is at 80, there is no obligation for the stock to go back to 100 just to get to your price back. The stock does not know that you own it, at what price you own it. And so all of that is in your mind, and that is why I keep repeating all the time that 80% of investing is psychology. See, basic thing to understand is, when are we exiting a stock? When we exit a stock, we are either moving on to another company, another business, which in my opinion is likely to give better returns than the one that we are getting out of, because everyone has finite capital. Nobody has infinite capital. Warren Buffett does not have infinite capital. The Yale endowment does not have infinite capital. The Norway's sovereign wealth fund does not have infinite capital. They may have large capital, right? They may have billions and trillions of dollars, but even that is limited, right? So the point I'm trying to make is that you have to sometimes sell something to buy something else, right? If you are invested in say 10 stocks, and you find a new stock which you think has a better return on investment than the 10 stocks that you own, you will have to do a switch. So there should be absolutely no hesitancy in selling out on a particular stock. And the second reason why we sell a stock is if there is a there is something which has changed in the company, right? In terms of the business, or in terms of the growth projections, or something like that. So something fundamental has changed. The third reason why we sell is if our investment stop loss has been hit. So if the price does not agree with the fundamentals, right? And ultimately, one thing, this might sound like trading advice, but it is absolutely hardcore lived advice of investor, which is that price is what ultimately matters, right? Price is the sole arbiter of whether you are successful in investing or not, right? It does not matter. Let's say you hold on to a stock for 10 years, and the EPS keeps going up, but the price has not gone up. You will not make any return, right? So there is no point in saying that I am holding a great company, but I have not made any returns for the last 10 years. And again, at the cost of my repeating myself, uh, this is one of the lessons I learned early in life from Hindustan Lever. I held on to that stock for 10 years with practically zero returns. Great company, no returns. And it's not that I bought it at very expensive valuations or something like that. The point is that the company went through a very long consolidation phase. Its growth had completely tapered off, and so on and so forth. So the point I'm trying to make is, when we are exiting a stock, there is a reason for it, and there should be absolutely no hesitancy to sell, whether it is at a profit or a loss, right? So these are things that no amount of coaching, no amount of telling, no amount of coaxing is going to help you. Ultimately, it is you who need to pull the trigger on your investment, whether it is buying or selling, and it is your mental makeup which is going to allow you to do it. So the other fact is that all of this comes only with practice, and once you keep doing it, right? Once you are able to sell, you will find that it sort of becomes like muscle memory, that you are able to do it the next time far more easily. For people who are absolutely unable to sell, you're having a complete mental blockage. One trick that you can try is, you can sell partially, right? So let's say you have 100 shares, you sell 20 shares, and see that the world has not fallen apart, that nobody has come and shot you or slapped you saying that why the hell did you sell this share, right? So then it becomes easier for you to sell the next batch of 20, 30, 50 shares. So that is another trick that you can use if you are completely getting stuck uh, when you have to sell. Okay. Moving on to the next question. What do you do for high PE stocks, but which have but the companies are great with large longevity of growth still remaining? Okay, so if you've been following my monthly Q&As, or if you've read my blog or email communication that I keep sending from time to time, you will realize that I'm not a very strong proponent of low PE investing. Right? So PE is one parameter or one indicator that you look amongst many. In fact, it is probably the last thing that you should look, especially when you are doing long-term investing. So when you're doing long-term investing, the first thing that you need to do is, you need to be a business analyst. You need to focus on the business. You need to understand, the opportunity size. In fact, that is one of the first things that you need to look at. What is the opportunity size that this business has? How large can it become? Can it do 10 times its revenues? Not irrespective of the time frame. Some businesses will struggle to uh, increase its revenues 10 times. So first thing is, that is important. Understanding the business, understanding whether the uh, business has pricing power, whether it has any competitive advantage. What is the competitive landscape looking like? What is the quality of management? Uh, what are the how efficiently can management uh, deploy capital in the business? Does the industry have tailwinds? Does the company have tailwinds? So these are things which are far, far more important than price. And you will see this if you look at the Indian markets and you go back the last, say, 20 years. You will see that uh, a lot of these companies which have given phenomenal returns consistently over the last 15, 20 years have always been expensive vis-a-vis the market. So if you look at a Pidilite or an Asian Paints or a Nestle, even a DMart, a Trend, Astral Polytech, all of these kinds of companies, these are companies which are coming to mind, offhand. These are companies which have continuously done well over a long period of time, and they have always been valued very richly. And at any point in time, even 10 years back or 20 years back, if you wanted to buy, say, a Pidilite, it would have been expensive compared to the market. Right? One of the reason I personally feel is that India is a market where very, very good businesses are not available in abundance. So people who have a large amount of capital to deploy, whether they are institutions, whether they are very, very ultra UHNIs, the opportunity landscape is very small, right? There are only maybe 100 200 companies that they can invest in, and within that there are a very few where you have visibility of earnings growth, where management is extremely good. So basically ticking all the tick boxes, and any company which ticks all the tick boxes, you will find that they are expensive compared to the aggregate of the market. So never be afraid of paying up, right? Because it once you pay up, you basically, provided of course you have done your homework, you understand the business, the levers of the business, the longevity of the growth. Because if you are doing a DCF, the moment you can have a visibility of growth for a longer period, uh, and you sort of you know back calculate that to bring it back to current period, you will find that valuations can become significantly high. Right? There could also be uh, temporary problems, right? COVID, a temporary blip or a temporary drop in earnings will optically make uh, P's high for a lot of stocks. Right? So you need to understand the normalized the P over say a 2 3 year period. You have to understand the strength of cash flows, the balance sheet. So all of this needs to go into your judgment, and P should not be the sole criteria. Unfortunately, it is the easy or the lazy way of doing things, and saying that low P stock means that there is a possibility of getting a re-rating and things like that. I'm not discounting that fact, but the point is that that is only a very small fraction of your ability to make money in the markets. I have personally made probably more money in uh, discovered stocks where P's have been reasonable to high uh, over the last maybe 10, 12, 15 years. So just because something's P is high, don't discard uh, a uh, particular investment. Similarly, on the contrary, don't be uh, you know over enthusiastic just because a stock's P is low. Right? So it goes both ways. Uh, okay, so the next question is interesting. How do you blend quants with fundamentals? Can you provide some examples? So first of all, I think there is this huge misconception that quant only means technicals, or quant means high frequency, that you continuously need to trade in out and all that stuff. Quant does not mean that. Quant basically means that you are not using your discretion, or you're not using qualitative judgments. You're not sitting and saying that I think that you know this company, the management is good. Okay, or you're not sitting and thinking that I think that the longevity of growth in is very strong in this particular company. You're not doing all those value judgments. What it means is you are looking at hard numbers. Those numbers could be fundamental from the company, they could be macro, they could be technical, they could be money flow, all of it, right? So you're looking at numbers, and you are then using quantitative data in some rules based system. So you have a rule which tells you that, okay, I will buy so and so company or so and so stock if it fills these criteria, right? So that is what, on a very very high level, what quant is. And unfortunately, in the Indian markets, I personally feel that most people don't understand quant, or they equate quant with either momentum or with high frequency trading, only because that is what we've all only seen in the public markets. You see a lot of momentum small cases or things like that, and people associate I mean, we also have a momentum small case, but that's only a very small part of quantitative investing or quantitative trading. A very large part of global uh, funds get managed by quant systems, which are for quantitative investments. There are value investing quant companies, quant funds in US. Uh, the other advantage of using a quantitative strategy or a non-discretionary strategy is that it will most of the time protect you from yourself. What typically happens is, when we are doing our own investment, and we saw this in today's Q&A, right? A lot of questions about not being able to sell, not being able to buy, etc., etc. All this is already taken care if you have a process driven or a well laid out system. Your system says that this is the point where you exit, you don't overthink it or you don't think at all. You've already thought about it, you've rigorously back tested it, you've understood what you're doing, and then you execute it. In a quant system or in this kind of a repeatable process, the advantage is that the base rate is going to work for you. See, in traditional technical analysis or in traditional fundamental analysis, what happens is you don't know the base rate, right? So for example, I'll give you a very basic examples. So let's say a cup and handle breakout in technical analysis. Now there is very little study which has happened uh, in terms of how many cup and handle breakouts actually are successful. So you don't know, right? You don't know whether a cup and handle breakout succeeds 10% of the time or 100% of the time or 50% of the time, right? Somebody has written that, okay, cup and handle is this pattern, it looks like this, and once you break out, this is the target, etc., etc. But how frequently does it fail? We don't know. Okay. Similarly, in fundamental analysis, you've done all your thesis, all of the stuff. Even then, you'll find that some of the best investors are getting 60-70% correct. The rest are not working out, right? Even Warren Buffett is making mistakes after 50, 60, maybe 70 years of being in this playing this game. He's still making mistakes, right? So in that kind of a scenario, uh, how do you ensure that you are getting out without getting biased, right? Or how what is your base rate of success in a particular strategy? So if you are buying, you have to then consciously think about why you are buying a stock and see that if you can make it as a process, right? So I'll give you a very basic example of using, say, how you can use a a fundamental and a technical, maybe a little bit put together. So this is just as an example. I'm not professing that you try and do this, but this is just an example and a very basic one at that. So uh, first thing that you think about when you're investing is, okay, so I want to buy stocks where the margins are going up. Typically, when will margins go up? When the company is actually in a very strong business footing, right? That is when margins will go up. So uh, you buy, let's say, in this example that I'm showing here, that I was just doing this yesterday. So you decide that I will make a 20 stock portfolio. I'll rebalance it every quarter. Okay. And what I will do is I will take stocks with the highest uh, quarter on quarter operating margin growth, companies which are profitable. These two are your fundamental parameters, and then you do a little bit of screening in terms of technicals, where your ADX is greater than 20, so basically a stock which is in trend, and where your current market price is greater than the 50-day moving average. So if you're just using this, and I tested it for the last 14 and a half years. So basically from 1st of January 2008 to 31st of, sorry, this is July, not June. I tested for 31st of July, or it will actually be the same because end of quarter, uh, it will be June, so end of quarter. The cumulative returns over this 14 and a half years for this strategy was 933%, which was a CAGR of 17.29%, versus the Nifty 500 cumulative returns of 191%. So here in itself, you can see that there is a huge outperformance, and you don't need to do anything, right? A lot of people will come and give you a lot of gyan, this, that. You just go back and see how many funds have performed, have given 18% or 17% CAGR returns over the last 15 years. You will struggle to find many, right? And here, you don't need to do anything. This is one of the basest of strategies, right? The max drawdown was 30%. So at the biggest drawdown that this strategy would have had is 30%. And the ratio of winners or losers is roughly 1 to 1.85. So basically, for every losing stock, you have 1.85 stocks that have gained. Now, this is just a beginning strategy. Now you can start thinking about how to tweak it and make it better, right? So will a 10 stock portfolio to perform better, right? Instead of 50-day moving average, if I do a 200-day moving average, is it better? Uh, can I get out if the stock falls below the 50-day moving average? Will that increase the returns? So etc. etc. So a lot of these kinds of uh, you know things you can look at when you are creating your system. Okay. You can create purely fundamental based systems, you can create purely technical based systems, you can have a system like this one, which is a techno funda system, where you are combining technicals and fundamentals, right? Although a lot of people don't understand, don't believe that technicals and fundamentals can work together. Here is a very clear example where it can work together, where you can use quantitative techniques to give you, without any pain, uh, significantly above average, above market returns, right? So these are just simple examples. I personally try to test many such examples whenever I have some extra time. I'll sit and try to think, what are the parameters that I can use? Can I tweak something here, there? And we keep trying to do that. So yes, the answer is you can blend quants. You can have quant systems with fundamentals, with technicals, with a blend of two. So quants is not rocket science. It's basically where you bring in quantitative. You're just using pure quantitative techniques, and you can use more and more complicated statistical analysis or tools. But what I have personally found is, the simpler your system is, the lesser number of variables, the lesser number of parameters, the more robust the system is, right? So maybe your return will be slightly lower, but they are not sort of curve fitted, so to speak, right? Uh, Moving on to the next question. Can you talk a bit about portfolio allocation? How about tail stocks? This is where we surprisingly have made more money. What's a good allocation strategy with respect to market caps or sectors? Does it make sense to reduce if a particular stock grows to say 25% of the portfolio? So first of all, the way I view a portfolio is, it should be a reflection of the way you view the future. Right? You have a time frame in mind, and you, within that time frame, you should look for, if you are investing for the long term, I mean, if you are an investor, you should look for businesses that align with your time frame, and the sort of quality kind of businesses which you think will do the best in that time frame. If you are trading, the same thing. If you know the best opportunities in that time frame is something that you should be looking at. And time frame has to be self-defined. It cannot be imposed on you by somebody else. You have to decide whether you are a long-term player, or you're a medium-term player, or you're a short-term player. Now understand that your investment horizon and time frame are two distinct things. I may be investing for the next 30 years, right? By that, what I mean is, I will not liquidate my portfolio, or I will not take a large part of the money out of my portfolio, but my investment horizon could be 1 year, 1 to 2 years, which basically means that I'm looking for business opportunities in that 1 to 2 year phase, after which I will sort of refresh and churn and move on to the next business, right? So you have to define your time frame. A good portfolio should have a mix of, I think, good defense as well as good offense. So you should have stocks where you are relatively sure that if the market tomorrow falls apart, they will fall significantly lesser than the market, and in the upswing as well, after the market recovers, they will also recover reasonably fast. So that typically happens in very very strong good quality companies. You should also have some stocks which are opportunistic in nature. So offense, where you're trying to play offense, right? With stocks that will give you significant amount of alpha. You could also try a mix and match of duration. So for example, I have some stocks which I have a 10 year, I'm hoping that I will be able to hold on to it for 5 years, 10 years. There are some stocks where I think that, okay, this uh, is more cyclical, so I'm looking at a 6 year, 6 month, 1 year, 1.5 year kind of horizon. So mix and match of horizons. In terms of tail stocks, I think a lot of what happens is people tend to have too many tail stocks. One, because they are unable to make value judgments in terms of quality, that okay, should I buy this versus that. So they study a stock, they look at it, and everything that they look at, they feel good. Hey, ye bhi acha hai, wo bhi acha hai, right? Then they end up buying both, and after a short time, you find that they have a 30, 40, 50, 60 stock portfolio with 1%, half percent kind of allocations. Now the point is, with 1%, half percent allocation, it's not going to make any difference to your life, right? So the whole idea is that you should, any stock that you buy should make some difference if it goes up, right? So the way I would approach a tail stock is, they should be few in number, basically those that you really think can scale up, and you are adding them as tracking positions. Now when you add something as tracking position, it should be a tracking position. By that, what I mean is, once it starts performing both fundamentally as well as in terms of price, then you keep averaging up, so that your small allocation gets added onto. So you may start with a 1% allocation, but as soon as you see that the stock is doing well and the business is doing well, you add, and bring it up to say 4, 5, 6% or 8%, 10%. So roughly, in my opinion, you should not be buying less than 3 to 5% in one particular one position. And what I tend to do is, I buy at initiation, or when I'm starting to buy, a maximum of 10%. Most of the time, I will let it ride up to say 15 to 25%. After which, I will take a very very hard look, and to see whether you know it is not skewing my portfolio, right? I don't want to get into a situation where a stock has is become 40, 50% of my portfolio, and tomorrow something really bad happens. Something, uh, there could be a fire in their single factory or whatever. I don't know what can happen. The only thing I know is, like, in Forrest Gump, as the quote goes, shit happens, right? And if shit happens, you don't want to sort of get uh, trapped in that. So it will your maximum allocation will depend on your asset allocation, your ability to take risk, your how closely you are able to monitor, how easy is it for you to sell. For example, for me to sell a stock is very easy. I mean, one fine morning I can get up and sell it, right, if I want to. So selling comes very naturally to me. Some people struggle to sell. So all of that you need to factor in before you decide a percentage. But my take is roughly between 15 to 25% is where you should where you should start looking and giving it some serious thought in terms of whether you should prune the position down a little bit. Because always think about risk first, right? Always think that what happens if something goes wrong. It need not You need not have to define what can go wrong, right? Like I always keep saying, right, before COVID, not a single annual report in any company in the world probably had a pandemic in its risk section, right? But it happened, and a lot of companies went down to zero revenues, right? If you look at a PVR or an Inox or a hotel or something or an airline, they did not have pandemic in their risk, but for a very long period their revenues went down to zero for something that was completely beyond their control, right? So that is a situation that I would want to avoid in my portfolio. I will always want to manage risk, because if I am able to survive today, if I am able to protect my capital, tomorrow will take care of itself. With that, thank you for sending me your questions. Keep sending them in, and thanks for taking the time to listen.